You finally got investor interest, but the sheet makes you uncomfortable. You Google a few clauses, ask your lawyer, and nod along, but you're still totally unsure what you're signing. In this video, we're going to look at the top 5 common mistakes and how you can avoid them so that you stay in control and protect your upside. Hi, I'm Kishore Dasaka, and over the last 20 years, I've worked with several hundred founders as a fractional CFO, helping them scale and make better financial decisions. The first term sheet mistake is liquidation preference. Liquidation preference is one of the most critical and sensitive topics in a term sheet. At a very basic level, it determines who gets paid first and how much when your company is sold. If you get this wrong, the valuation number absolutely becomes irrelevant. So how do you solve this problem? First, you have to understand the investor's perspective. Investors put in money to fuel your business growth. And in return, they want to ensure that if a company sells for a low amount, a downside scenario, they get their capital back before the founders do. And this is fair. This is pretty standard as well. However, things really get complicated when investors ask for more than just their money back. You will often see a term sheet that says a 1x preference or a 2x preference, or sometimes even higher. Let's look at an example to see why the difference between 1 and 2 determines whether you walk away rich or you walk away with nothing. Let's assume Startup Inc. raises $5 million from an investor. The founders have been slogging for several years to build this. 3 years later, the market turns and Startup Inc. is sold for $8 million. Now, there are two scenarios here. Scenario 1, the 1x preference. In this case, the investor gets 1x their money back first. So from the $8 million exit, the investor takes their first $5 million back. The remaining $3 million is available for the founders and employees. And this is a fair outcome. Scenario number 2, the 2x preference. Now, let's say the investor asks for a 2x preference during negotiation. So in this case, the investor is entitled to 2 times their investment before anybody gets paid. $5 million multiplied by 2 equals 10 million. The company sold for 8 million and the investor gets 10 million. So the investor takes the entire 8 million back. Now the founders who slogged for years, they effectively get 0. So you sold your company for millions, but because of that one clause, you're technically in a deficit. There is no gray area here. Anything other than a 1x liquidation preference is a disaster for the founders. When an investor asks for a 2x or a 3x, they aren't looking for downside protection. They're looking for a guaranteed multiple on their return, regardless of their performance. So here's the thumb rule. Accept 1x. So if you have a term sheet on your desk with a 1.5x or a preference, do not sign it. The next trap in the term sheet is arguably worse than the liquidation multiple. This is the participation clause. While liquidation preference determines how much is protected, the participation clause determines if the investor gets to double dip into your hard-earned profits. If you see a participating preferred, that is a red flag. So what does that mean? Non-participating preferred is industry standard. It forces the investor to make a choice. Either take the money back, which is the downside protection, or convert their shares to equity and share the upside with the founders. They cannot have both. Usually, most investors convert their shares to equity and take home the upside. But then there is this participating preferred stock. It allows them to take their money back first and then turn around the shares in the remaining proceeds with common shareholders. Let us look at an example to see how this double dipping hurts the founders. Let's assume Startup Inc. raises $5 million equity for a 25% stake. The founders have been slogging for years and finally sell the company for $25 million. Now, scenario 1, non-participating. The investor here has a choice. They can either take back the original $5 million or they can convert to 25% ownership. Now, 25% of ownership in a $25 million stake is about $6.25 million. Since 6.25 is higher than 5 million, they obviously convert and they take $6.25 million back home. The founders and the team split the remaining 18.75. Now, this is a fair scenario. Scenario number 2, which is what we call the participating preferred share. Here, the investor does not choose. They get both the options. First, they take the $5 million liquidation preference off the top. Now, that leaves $20 million remaining in the pot. But because they're participating, they also get the 25% share in the remaining money. Now, 25% of the remaining $20 million is another $5 million. So, the investor walks away with $10 million in total. Now, even when the investor had a 25% stake, 10 million on 25 million is effectively a 40% stake. Participating preferred essentially lowers the exit value for equity holders. It is a mechanism for investors to squeeze the extra return at your expense. And here's the thumb rule. Always insist on non-participating preferred. If the investors push back on participating, you have to shake your hands and walk out of the deal. It is a red flag and a signal that you're being squeezed. And if that is the intent at the term sheet stage, no one can save you after you take the money. The next clause is the anti-dilution clause. No founder expects their equity valuation to drop. But the markets are unpredictable. COVID happened, markets crash, and global macro events do happen. When such events happen, the anti-dilution clauses protect the investors. So basically, if you raise money at a later stage, at a lower valuation in the future, the investors are protected because they came in early and they took the risk. In simple words, they get free shares to compensate for the drop in valuation. You must understand that investors want protection against their investment losing value. So if they paid $10 per share today and you raise capital for $5 per share tomorrow, they want their original price to be adjusted downwards so that they get more shares to make up for the loss. There are two ways to calculate this adjustment: broad-based weighted average and full ratchet. The weighted average takes into account the size of the, it is a moderate adjustment, whereas the full ratchet ignores the size of the round and focuses only on the price, and that is why it is extreme. Let's look at an example to see how these two formulas impact your ownership. Imagine an early investor paid $2 per share. Later, the market crashes and you have to raise a small emergency round at $1 per share. So we have two scenarios. Scenario number one, the broad-based weighted average. This formula looks at the round and says, okay, the price is lower, but only a small amount of capital was raised at $1. So the investor's price might adjust from $2, which was their original price, down to roughly $1.85 per share, which is not too bad. They get a few extra shares to get compensated. The dilution to you, the founder, is minimal, and you live to fight another day. Scenario number two, the full ratchet. Now, this clause is absolutely ruthless. It doesn't care how much you raised in the second round. It strictly looks at the price of the new round. And because you sold the stock at $1, the investor's original price of $2 is instantly reset to $1 per share. And therefore, the investor effectively doubles their number of shares for free. Now, this triggers a massive dilution for founders in the event of a down round, often making their stake worthless overnight. Full ratchet is really anti-founder. It protects the investor by punishing the founder for a market downturn. And it can usually create a spiral where the company becomes uninvestable in the future. Why? Because the founders have lost too much equity to care anymore. So here's the thumb rule. Always, and I say always, insist on a broad-based weighted average because that is market standard. It aligns the penalty with the actual impact of the down round. Never sign a full ratchet. If an investor demands a full ratchet, they're asking for a total insurance at the cost of your survival. And if you see this in the term sheet, negotiate it immediately or walk away. The next clause is what we call the reserved matters. Reserved matters are a list of specific actions that require approval from your investors, even if they're minority shareholders. If this list is drafted poorly, you might technically be the CEO, but you won't be able to run the company on your own. So how do you approach this problem? You must distinguish between a strategic protection and operational control. Investors need protection against major changes that fundamentally affect the business that they've invested in. For example, they should have a say if you decide to sell the company or if you issue new shares that dilute it. Now that is reasonable. However, the trap is when investors expand this list to include day-to-day decisions. That turns governance into a micromanagement clause. Let's look at the difference between a healthy board and a paralyzed one. Scenario one, a strategic-only board. The list of reserved matters here is short. It includes big ticket items like selling the company, winding up the business, or changing the articles of association. If you want to sell the company, you need their permission. If you want to run the business, you are free to execute. Now, this ensures alignment of the big picture while giving the founders the speed that they need. Scenario two, the operational creep. Now, here's where investors slip operational veto rights. And this list includes items like hiring anyone with a salary over $50,000, signing a contract over $10,000, and suddenly you find yourself a great sales head. But you can't hire them because the investor hasn't replied to your email. You need to buy new laptops, but you're waiting for board approval. Then you become the bottleneck in your own startup. Speed is the only advantage that a startup has over a large corporation. Operational reserved matters kill that speed. So here's the thumb rule. Reserved matters should only be strategic in nature. Never accept any operational restrictions. Hiring, firing, budget execution, vendor contracts, these are all management prerogatives. So if an investor wants to control those decisions, they should be running the company, not you. Keep the list short, keep it high level, and ensure that you retain the freedom to execute the day-to-day decision. The last landmine is the board seat. A board seat is the most expensive real estate on your cap table. Many founders hand out board seats like a participation trophy for every major investor. Now, that is a mistake. A board seat is for governance and strategy and not for product updates. So, if an investor asks for a board seat, what do? You need to understand what the investor actually needs versus what they're asking for. Investors usually ask for a board seat because they want visibility over two things: visibility and control. But here's the reality: they don't need to get a board seat to get these. They control these matters through the reserved matters clause that we just discussed. And they can get visibility through the information rights clause. Since they are already protected by these two clauses, a board seat in most startups is often redundant. Let's look at the impact of a crowded board. You have 3 directors, 2 founders, and 1 lead investor who wrote the biggest check. Decisions are fast, meetings are strategic, and you spend 90% of your time running the company and 10% managing the board. Now, this is efficient. Scenario number 2, the parliament board. You gave a seat to every investor who asked for it. Now, you have 5 or 6 people around the table. Scheduling a meeting itself takes weeks together, and every decision turns into a debate. You spend more time managing the investor egos than managing your own product. Worse, once someone is on the board, they have a fiduciary duty to the company, but they often act in the interest of their own fund. And also, removing a board member is incredibly difficult. A board seat is not a right. It is a privilege owned by significant ownership. So here is the thumb rule. The first one is to set a threshold. Unless an investor owns a minimum of 20 to 25% of the company, they do not get a board seat. Period. Small checks do not dictate strategy. The second is to offer an observer seat. If push comes to shove and a smaller investor demands an involvement, offer a board observer seat. They can attend meetings, hear the updates, but they cannot vote. The third one is relying on reserved matters. Remind them that their investment is safe because the reserved matters clause is there. They don't need to vote on a daily board to be protected. You can still keep your board small, or you'll have to lose your agility. Building a $100 million company on a broken financial foundation is a recipe for disaster. If you want to master the math behind the numbers and keep more of what you build, hit follow. And I will see you in the next video.